Well, it turns out it's not turtles all the way down, it is debt all the way down. U.S. consumer debt just reached an all-time high, and it is over half of the national debt amount, coming in at $16 trillion. We're going to dive into exactly what kind of debt is making American households loaded up more than ever, and what people should be doing about it. Ready? Let's dive in. All right, take a look with me at this chart from Visual Capitalist. Visual Capitalist every once in a while comes out with a very interesting infographic, and this one is no exception. We are looking at the U.S. consumer debt here, which has approached $16 trillion. Not quite, $15.6 trillion. Right now, the U.S. national debt is at $30 trillion, so we're coming up at just over half. So in the fourth quarter of 2021, U.S. consumers brought their total debt up to this amount. So right here in this chart, we're looking at two different sections. We've got this top section, which is red. That is housing debt. That is mortgages. And then this bottom section, which is non-housing debt. And we'll dive into a breakdown of that. But what's important to notice here goes back to 2003, so this is 20 years almost of debt history. We can see that non-housing debt has grown pretty much every single year, with the exceptions of the decline in 2009, and then 2010 was just kind of a flat, grew a little bit, and then picked up its pace again. And then obviously 2020 there was a little bit of a dip in debt, and then continuing to rise after that. Very different than the housing debt, which experienced a severe decline during those years, and then no decline since. And so this was the housing bubble. Now, it's important to note here that this spike in housing debt right now is very different than this spike in housing debt. We are seeing subprime borrowers only representing 2% of the total, whereas it was at 12% between 2003 and 2007. Lending standards are extremely tight right now. They have been tight for years. There's no change there. There's no ninja loans happening right now, the no income, no jobs, no assets. We are not seeing anything like that. Lending standards are extremely tight, high credit scores, high incomes, and importantly in the housing market, there is lots of equity in these houses, because anybody who purchased their home more than a year ago is up 10%, 20% or more, especially somebody who bought 3, 4, 5 years ago, and depending on the city, some people have 50% or more equity just from the price appreciation alone. And again, most of these are not adjustable rate mortgages. Most of these are not high interest. Most of these are fixed rate and then refinanced over the last couple of years. So this housing debt, while it is a large number, the debt service cost is very low, because it's either you get cheap assets or cheap money, and we've had cheap money for a long time. And so lots of people who own a lot of mortgage debt, their housing payment is still relatively very small, relatively manageable. Now, again, that's not everybody. If housing prices start to come down, if rates continue to climb really quickly here, people will be in trouble. Some people have been getting into adjustable rate mortgages. Hopefully, nobody who watches my channel, because I've been saying this entire time, fixed rate mortgage, good. Adjustable rate mortgage, bad. Stay away. And we have just seen new news come out that adjustable rate mortgage demand has surged to a 14-year high, because people can't afford regular mortgages now, so they're getting suckered in by that low initial rate. Now, we have to take this with a grain of salt. This is not total adjustable mortgages in existence. This is demand for new adjustable rate mortgages, and the mortgage applications to purchase a home rose 5%, and the share of ARMs in applications increased to 11% of overall loans and 19% by dollar volume. So again, that's not of all existing, that's just of the new applications. And so yes, it's a worrying sign for what's to come. Nothing to be concerned about right now. All right, let's go back here to the non-housing debt portion of this, which has just continued to steadily climb. we're going to come down here and see the breakdown of the non-housing debt between credit card debt, auto loan debt, other, and student loan debt. So the highlight here is that auto loans were the fastest growing category in 2021. So we saw in 2003, it was down here, and it really kind of just trickled along, moving sideways until about 2011, 12, 13 is when it started to tick up higher than where it was before on average, and has just recently exploded. Now, obviously, one of the main drivers for this is the slowdown or the aging vehicle fleet in America, and cars are consumable goods. They break down, they get in accidents, they go away, they don't stick around forever. And so as people have been needing to replace their cars because of accidents or because they've broken down, we have not been having the same number of new cars enter the market, especially over the last couple of years because of the chip shortage. We've seen a lot of the new car fleets just sitting in lots waiting to get their chips to get sent out into the market. So used car prices have gone up, and so people finance these things because they're expensive, and so you're going to see that portion explode as a result of that. Now, this portion in 2003 was the lowest of the four, and now it's the highest. That is student loan, and obviously we've seen over the last 20 years that matches with what you would expect because more and more people who don't need it have been getting a degree in degrees that don't matter, and most of those people are not able to pay off their student loans as a result of getting a degree that has no return on investment, degrees in humanities and things like that won't pay off in the long run. And so we've seen student debt just explode recently. Although, as this points out, student loan growth has tapered off since the start of COVID-19 in 2020, and there have been things like forbearance and forgiveness for certain people in certain amounts. And so this is a good sign that student loan debt has been tapering off. This is not something that we'd want to see grow in perpetuity. This is something that we'd want to taper off. We want people to get people actually getting real skills instead of just going to get a degree because the previous generations it would have been good for. And so everybody just, as they turn 18, they think, well, I've got to go to college, got to get another degree, and then it ends up being useless, and now they have a bunch of debt and they don't have any income to be able to pay for it. Credit card debt, surprisingly, has stayed largely the same here. It has fluctuated, but it has stayed largely the same. But this recent tick up is actually a little bit concerning because credit card debt ticks up during hard times. So we saw 2007, 2008, 2009 ticked up, and then in periods of recessions and when the crash really hits, then people really get aggressive at paying it off. And we saw in 2019 a spike up here, and then a bunch of people got a cash injection, and so that debt started to get paid off. But we've seen a recent big spike tick up here in credit card debt. That is not a good sign moving forward. That means people are running out of savings, running out of cash. Inflation is causing people to not be able to pay the bills, and so more and more is getting loaded up on those credit cards. Credit cards are another thing that I say stay away from. This is very bad. You don't want to be loaded up with a bunch of credit card debt because there's virtually no regulation on how much you can be charged on your interest. So with credit cards, they'll always be more than the rate of inflation. So you're never going to get ahead by having a large credit card balance. You want to make sure that credit card balance is always zero. You're never rolling it over to the next month because that interest rate is going to continue to rise. As inflation rises, so will the interest rate because it's adjustable, and it will always be high because it's not collateralized debt. They can't come and take an asset from you if you default on your payment like a mortgage. And so those rates are always going to be really high. And as inflation gets going, if it really starts getting up there, 10, 15, 20, 25%, those credit card rates are going to go much higher, getting many people to the point, hopefully not, hopefully this doesn't happen, but it's possible, where many people go bankrupt just because they had 1 or 2 months worth of expenses stored up on a credit card balance, and they could never get ahead because that interest rate started to become more than their car payment, more than their mortgage, more than their income. Very dangerous spot to be in. Get rid of credit card debt as fast as possible. So rule of thumb here is if it's fixed rate debt and that interest rate is lower than the inflation rate, then it's safe debt to keep around. Maybe not the smartest move. Maybe it's not going to make you rich, depending on what you used to use that money to buy, but it's safe. Things that are adjustable in inflationary periods are not safe debt to keep around. Get rid of that as fast as possible, because the reality is in inflationary periods, money becomes more abundant. That means it gets easier to get your hands on that money because incomes go up. And so if the number of dollars that you owe stays the same, but the number of dollars in the system grows and you can get more of those dollars, that debt gets easier for you to pay off. It takes less cost of real wealth, whether it's time or labor, to give in order to get money to pay off the same amount of dollars. No matter what happens, fixed rate debt, you owe the same amount of dollars. Adjustable rate debt is the opposite. The number of dollars that you owe can go up, and they will go up to compensate for the new supply of dollars entering the system. Now, in deflationary periods, this is a little bit different. In deflationary periods, all debt is dangerous to have because the number of units of money, the supply of money, contracts. It gets harder to get your hands on money. Income and prices go down. That means you have to give more labor, more wealth, more cost in order to get your hands on dollars to pay off that debt. So if you're extremely risk averse and you think, hey, there's a chance we have extreme deflation where we have a massive amount of unemployment and we have prices of everything start to collapse, then any debt becomes dangerous. So debt is a tool that makes you fixed rate debt, if you buy assets, will make you rich from inflation and make you poor from deflation. So you want to be careful depending on which one you think is most likely or likely at all or more likely, and how aggressive you are and how conservative you want to be. That's how you have to think about debt. For inflation, fixed rate debt that you use to buy assets is safe and can actually increase your wealth. But any sort of debt gets harder to pay off during deflation. So if you want to completely de-risk yourself, you get rid of that debt. You won't get as rich from inflation, but you won't be at risk from deflation. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.